When it comes to investing in the stock market, the only thing that's worse than not making the right moves is making the wrong ones. Faced with thousands of decisions from how to invest, what to invest in, and when to invest, it's easy to fall into one of several mistakes that can get the odds set against you. Compound those mistakes and you can easily, painfully, and slowly see that portfolio dwindle bit by bit till you're down to zero. A reality no one wants for themselves. But don't be all gloom and doom. Avoiding those mistakes is exactly why I have made this video for you today. Throughout the next few minutes, we will discuss in depth what mistakes to avoid when investing, and we will do so with wisdom sourced from one of the greatest investors of all time, Peter Lynch. Honestly, given Peter Lynch's impeccable investment record before his active retirement, I can't think of anyone better to be able to quote on this subject. With a 29.7% average return over a space of more than a decade, Lynch pretty much knows everything to avoid in this art form. So, if you're ready for a mistake-free form of investing, then hang on tight, I've gotcha. By the time you're done here, you will have refined your investing to a whole new level. Without wasting any more time, let's get into Peter Lynch's 7 investment mistakes to avoid.
Here's a good one. If it's gone down this much already, it can't go any lower. I remember when Polaroid went from 140 to about 107, and people said, if you ever get Polaroid under 100, you got to buy it. You just back up the truck, buy the stock. Stock could get to 110, then rally, fall 103, go 112, go 105. They said, gets under 100, buy Polaroid. Polaroid broke 100, people started buying it, and within 9 months, the stock was 18. I saw the same thing with Avon Products. So just saying, it's gone down this far, how much lower? I mean, it's crazy, but,
One of the primary investor mistakes that people make is to invest in stocks without a clear knowledge path to profit. For the most part, people defer to the conventional statements or thinking ideologies, where they invest in a stock just because it has gone down hard enough. So they generally think it can't go any lower. As you can imagine, this is a horrible way of looking at an investment. Peter Lynch says that people who often say, "It's gone this much lower already, how much lower can it get?" are often in for a big and unpleasant surprise. Alternatively, a lot of people also sell stocks, not on their own merits, but based on the fact that it has gone up for long enough, how much higher can it get? Again, this puts you in a place where you can have your profits because you are investing and making decisions based on generalized assumptions. In recent times, a lot of people made this mistake with Tesla stock. So, what should you do? Well, Lynch believes tempered action and research is the great equalizer. When you thoroughly research a stock and make buying or selling decisions based on facts and data sets, you are more likely to come out in a winning space at the end of the day than when you commit your funds using these generalized views. Before we move on to the next mistake, don't make the immediate mistake of missing out on getting 2 free stocks as a sign-up bonus. You can get these by clicking on the link in the description below and signing up for Webull, a top trading platform. It's a win-win scenario. Okay, let's get to Lynch's second mistake that investors must avoid.
Eventually, they always come back. Here's another one that sucks. That's a technical stock market term we just use only in the stock market. The RCA just about got back to its 1929 price when it was backed out by GE. Manville never came back. International Harvester, even with its name changed and adjusted for splits, hasn't got all the way back yet. Western Union, double knits, remember those wonderful things? Floppy disks. They don't have to come back, but they say eventually they always come back. Not true.
A lot of people are guilty of this, and yes, I'm looking at you, Timothy and Sarah. Don't you click away, you listen. Lynch says that more money has been lost in the markets by people who have said this infamous line: "Stocks always come back." The reality of the situation is that it's not really quite that simple. Stocks do not always come back to previous highs when they start dipping. History has shown that a lot of companies went bankrupt or fell to never recover again. And this is something that an investor must keep in mind. Even though the S&P 500 as a whole is going up and has been doing so in the past decades, that does not mean that every individual stock is doing so. As an investor, you must have an entry and exit strategy. Lynch says it's foolish to keep holding on to a free-falling stock all in the name of "it'll come back," when the facts do not support that school of thought. This is why you should be bold enough to cut your losses in the better interest of the rest of your portfolio. Remember, not all stocks come back to previous highs. Acknowledging this simple yet hard truth will save you a lot of pain in the markets.
Here's a great one. It's $3. How much can I lose? This is a great one. Because get out. This is, I don't have a computer and I can't do high-level math, but just do this one. So let's say your neighbor buys $10,000 of a stock at 50, and the stock's now 3, and you put $25,000 in at 3. If it goes to 0, who loses the most? A lot of people cannot answer this question. If you put $1 billion in at 3, you can lose $1 billion. They blow taps in lots of companies every year. They can go to 0.
I just invested X number of dollars at this point. How much can I possibly lose? Okay, well, I bet that you know at least one person who has said this at some point in their investing journey. Lynch says that this is one of the dumbest things people can say in their quest to make a profit. The reality is that even if you are buying a stock at what may seem like a cheaper price, if that entire company goes down and the stock goes to 0, guess what? You will lose just as much as somebody who bought at a higher price points, because then both of you will be at 0. To invest on the assumption that you won't lose a lot because you have timed the bottom is not only a fool's errand, it is a sad but sure way to go broke in the future. Invest for the right reasons, and always realize that no matter how good your entry price may be, there is always the risk that a stock may decide to go lower. Risk tolerance, rational thinking, and research are the names of the game with this point. Write that down, Timothy. The 3 R's will save you from a lot of pain.
Here's a good one that helped me a lot. It's always darkest before the dawn. This business is terrible. It's awful. You ought to buy the group. This is not a good way of making money.
I personally may be guilty of having done this a long time ago, but through the process of learning, it's a thing of the past. Peter Lynch says that people who use the saying, "it's always darkest before dawn," inevitably set themselves up for a brutal level of failure. This saying assumes that at a low or a down point in a company, things have reached the ultimate worst and they can't go down more. To think that is the ultimate level of naivete and ignorance. History has proven that in the stock market, things can always get much worse. Never assume that because your portfolio is down, it will recover by virtue of "it's always darkest before dawn." In the same breath, never assume that there is no possibility for a worse outcome. Structure your portfolio in such a way that even when the hard times come, you can see them through. Also, be in a fluid space where you can cut off that which does not serve the greater good of the portfolio. Peter Lynch says that the alternate saying that he learned in the textile industry is what may have saved him from heartbreak several times. In the textile industry, the saying is actually "it's always darkest before pitch black." Always be prepared for things to be much worse.
When I rebound to 10, I'll sell. Here's a great rule. Somebody buys a stock at 10, and it falls to 6. They say, if it gets back to 10, I'll sell. Now, I think the math, 4 and 6, I can handle this level of math. I think that's about a 66% return. You ought to buy it. If you think it's going back to 10, you ought to buy the hell out of the damn thing. But they think if it gets back to 10, I'll sell. Now, what you ought to do is never put down a round number, because I think for the next 26 years, the stock will go between 5 and 9.25. It'll never get to 10.
For those who love saying, "when it rebounds, I'll sell. When it does this, I'll react like this." All of you need to understand something fundamental according to Peter Lynch. Listen, folks, the stock market is not your friend. It does not care about your feelings, nor does it care about who you are. Do not let your targets be so hard-fixed that you lack the flexibility to adapt to the market's movements. The stock market is never going to bend to your every whim. It's not going to move at your command, neither is it going to conform to Timothy's expectations. Instead, function on a factual and knowledge basis. The market rewards those who adapt, research, and do their due diligence. To try and guilt the market into submission is a mistake best left for those who love to thrive in poverty.
Here's a very dangerous one. Look at all the money I've lost I didn't buy it. People do this all the time. They say, I didn't own Blockbuster, I didn't own Home Depot, I didn't own Toys R Us. Eric, it was very nice to say some nice things about when I came up here, and Manny has been nice to me. I literally, one of my books listed on 2 pages, in the 13 years I ran Magellan, I listed, I think about 200 stocks, A through L, on the New York Stock Exchange. They went up tenfold or more that I didn't own while I ran Magellan. I had owned lots of stocks. I listed 200 stocks A through L. I stopped at the letter L, and I didn't own any of these shares. They went up tenfold or more, and I was able to do okay with Magellan. And people worry all the time about missing Microsoft, missing Western Digital, missing United Airlines. They spend all their time worrying about stocks they miss. You cannot lose money in a stock you don't own. That's a very important. The only way to lose money is buy a stock, have it go down, and sell it. That's the only way.
This was one of my favorite mistakes that Peter Lynch has explained in the past, because I see so much of it around. Even during the crypto highs, the GME highs, and the Tesla highs, such words were endlessly echoed by people over and over again. Peter Lynch calls this foolery. To invest in stocks and to profit from them requires one key component that so many sometimes forget. You need to buy that stock. Therefore, if you do not buy said stock and then decide to complain about how you have lost out on potential income, you are no better off than the man filled with delusion. And let me be the first to tell you this, the stock market does not reward delusion at all. It robs the delusional people blind. What tends to happen is that those who miss out on opportunities will be all too eager to capitalize on the next chance without having done their due diligence. And this often results in jumping into ill-advised ideas, resulting in horrendous losses. I'm sure you all know a few people who have done and been through this. Basically, stop wallowing over what you perceived as missed chances and focus on the future opportunities that you can research and apply yourself to.
Stock has gone up, I must be right. Stock has gone down, I must be wrong. I'm convinced that people do this all the time. They buy a stock at 10, they buy a little bit of it, it goes to 13, they now say they don't know anything more about it than they knew when they bought it at 10. They have no idea what this company does, but it's gone to 13. Now they take a second mortgage in their house and buy it at 13. The best thing that could happen for us is to go directly from 10 to 4 for these folks. You know. It's going to go to 4 eventually, but it goes to 13 in the middle. They're convinced now, they bought 100 shares at 10, now they buy 20,000 at 13. And all the fact is the stock went from 10 to 13 is it went up. The average movement of a stock on the New York Stock Exchange this century, between its high and its low, has been 50%. The average stock on the New York Stock Exchange. That means the stock started the year 20, sometime during the year sold 16, sometime during the year sold at 24, might have finished the year 21, might have finished the year 19. The average range of a stock on the New York Stock Exchange is 50% in 12 months, between its high and its low. So stocks go up and down a lot within a year. And to say this stock is going up means you're right doesn't mean a damn thing. So don't buy often on that one. That is not a good one.
Oh boy. If you've ever made this mistake or thought this way, I'm going to need you to drop a note in the comment section below. Peter Lynch emphasizes that a lot of people go haywire and crazy when they get in a winning position. By being a couple of profit points up, they start to assume that their way of thinking and investing is right, and double up on positions that may come crashing down at the end. Don't assume that just because you are currently profitable, you are automatically right. No. Even a broken clock is right twice a day. Do not let profits cloud you. Always do your due diligence on matters, always. Investing rewards the wise, the bold, and the insightful. Like Buffett has always said, the stock market is a wealth transfer tool. Just don't be the one being hustled. There's a popular adage in Africa that hints towards the fact that when your elders speak, it's wise for one to listen. This video is a whole tribute to that adage. When one of the greatest investors of all time speaks and highlights mistakes and errors that need rectifying, it is prudent to listen and use it as a chance to improve on your own shortcomings. By working on the mistakes that Peter Lynch says to avoid, I am sure that in this year, and in the years to come, your investing prowess will be elevated, bringing you more profits than you can currently fathom. After all, Peter Lynch calls this list of mistakes to avoid timeless. And here on Business Basics, we have to say that we wholeheartedly agree. Here's to hoping that you will be wise enough to listen. Cheers.